All right, let's get into it. Today on Talk Tickers, we're breaking down the latest from Element Solutions. That's ticker ESI. They just dropped their Q2 earnings, and let me tell you, the call was full of confidence. And the market? Well, the market definitely took notice. And here it is, the number that really kicks things off, a 4.3% pop on earnings day. We saw a big jump in trading volume too, so you know Wall Street was paying attention, and clearly they liked what they heard. The big question is, why? Let's dig in and unpack it.
Okay, first up, the Q2 beat and raise. This is all about the headline numbers that got everyone talking. It really boils down to a classic beat and raise scenario. You know, the market loves a simple, clean story, and ESI absolutely delivered one this quarter.
So let's break down the numbers. On the bottom line, you're looking at adjusted earnings per share of 37 cents. Now, that just edged out the consensus of 36 cents, fine, but not the main event. The real headline here was the top line. Revenue came in at $625 million. The street was only looking for $587 million. I mean, they blew past that by almost $40 million bucks. That right there as a really strong beat.
Now, this is where it gets really interesting, because you have to look past the headline numbers. See, reported revenue growth was only 2%, but look at the organic growth. That's a much healthier 6%. So what gives? Well, the difference is a business they sold off, their lower margin graphics business. So if you strip that out and look at the actual core business they're focused on, well, it's growing 3 times faster than it looks on the surface. That's the real story. So we've established that the core business is strong. But where exactly is that strength coming from? Well, it's all about one thing: electronics. This is the engine behind their success. For years, this has been their strategic focus, and this quarter is proof positive that the big bet is really paying off.
And you don't have to take my word for it. The CEO, Ben Glicklich, said it himself on the call. He pointed out that this was their 5th consecutive quarter of high single-digit organic growth in electronics. Think about that. This isn't just a fluke quarter. This is a pattern. It signals incredible consistency and just solid execution in what is, by far, their most important market.
In this chart right here, it just drives the point home visually. I mean, look at that. Electronics is now making up nearly 70% of the entire company's revenue. So when we call it the growth engine, honestly, that doesn't even do it justice. It's pretty much the whole car at this point.
So let's drill down a bit. Where did that 9% organic growth come from? It was pretty much firing on all cylinders. We're talking high-performance computing, data centers, all the stuff the big cloud giants are pouring money into. Their wafer-level packaging products up over 20%. And on top of that, they're making a big push into the Asian EV market. This isn't random growth. They are perfectly positioned in some of the most powerful, long-term trends in the entire tech sector. Okay, but what about the other side of the house, the industrial and specialty segment? You see that 1% organic growth and maybe you think, meh, but hold on. That number is actually incredibly impressive when you realize it had to swallow a 17% headwind from selling off that graphics business. So to still come out positive, it just shows you how resilient that core industrial business really is, even when the broader economy is a bit shaky. All right, so that's the story of the quarter that just happened, but we all know the market is forward-looking. The stock's big move was just as much about what's coming next, so let's turn to the guidance and future catalysts. And this is a big one. They raised their full-year guidance for adjusted EBITDA. They're now expecting between $530 and $550 million. They also explicitly said that Q3 is going to be even stronger than Q2. When a company does that, it's a huge signal of confidence. They're telling the market, hey, the momentum we saw in the first half, it's not stopping.
So if you're watching this company, here are the 3 big things you need to keep on your radar. Number 1, can they actually hit this higher guidance for the second half of the year? Number 2, does that crazy demand from data centers and high-performance computing stay strong? And number 3, and this might be the most important of all, the ramp-up of their brand new technology, something called Kuprion.
So what is this Kuprion thing? Well, it's their new active copper tech, and it's a huge deal. It's basically designed to solve one of the biggest problems with advanced computer chips: how to keep them cool and powered efficiently. Get this, demand is already higher than what they can produce in their labs. Their first real production site is set to go live by the end of this year, and they're already planning for a second one. Management is targeting over $100 million in revenue from Kuprion alone by 2030, and on the call they basically said that target is looking very likely, maybe even a little conservative. This is a potential game changer. Okay, let's put all these pieces together. This brings us to the next call, where we formulate a forward-looking investment idea based on everything we've heard.
So after all that analysis, what's the actual trade here? How do you position yourself for what might happen next?
It really boils down to a classic battle. On the one hand, you've got the bull case. These long-term trends in high-end electronics aren't going anywhere, and you have this huge lottery ticket with Kuprion that could pay off big. On the other hand, the bear case is all about the big picture, the macro stuff. What if tariffs mess up the supply chain? What if the industrial economy slows down even more? Or what if the EV market hits a wall? It's really a story of a great company versus a potentially tough environment.
So when you have a setup like this, with two really different potential outcomes, one way to play it is with an option strategy called a long strangle. Now it sounds complicated, but the idea is simple. You buy an option that profits if the stock goes way up, and you buy another option that profits if the stock goes way down. You're basically making a bet on a big move, and you don't even have to be right about which direction it goes. And that brings us to the core thesis. Right now, it feels like the market is pricing in a business-as-usual scenario, but the next year or so could be anything but. You've got this binary outcome. Either Kuprion is a home run and the stock could take off, or those macro fears become a reality and the stock could get hit hard. A long strangle is a way to position for that explosion in volatility, capturing the upside from either of those powerful opposing forces.
So what's our final call? Despite the risks, we think the potential here is just too big to ignore. The execution has been fantastic, and that Kuprion catalyst is a real game changer. We believe the upside potential outweighs the macro risks, and for that reason, we're giving this an outperform rating.
And of course, we have to end with this. Please remember, this is not financial advice. Everything we've discussed today is purely for informational and educational purposes. You should always do your own homework and talk to a financial professional before making any investment decisions.